moving forward to another winner of the papers tournament. As I said, there are 5 winners out of over 30 submissions that have been processed by the academic committee. And this one is pretty related to the topic that has just been discussed, because FinTech lending is definitely something that is always a subject to frauds, and it always has had attention as something that needs to have new mechanisms put in place. So I'm very happy to introduce you to Professor Jianfeng Hu, Associate Professor of Finance at the Singapore Management University, who will present his paper, One Size Doesn't Fit at All.
Thank you. Well, first, I would like to thank the conference organizer for having us here. It's a nice pleasure to visit Kazakhstan for the first time. I've been enjoying the weather very much. Okay, something very quick about myself. I actually wear 3 hats. Right now, I am an academic researcher. I am the head of finance department at Singapore Management University. At the same time, I also manage my own systematic macro hedge fund. So we write computer algorithms to make buy-sell decisions, in all futures, all asset classes around the world exchanges. And finally, some of my investment expertise recently has been used by FinTech companies. We start building back-end applications for a lot of the FinTech, now including crypto, okay? In fact, today's paper is mainly about FinTech lending, although the crypto exposure is the latest addition we have. If time allows, I can share more with you later. Okay. So we have been talking a lot about crypto in this conference so far, and now we're going to switch slightly to FinTech lending. But this talk, I have decided to modify it toward more general FinTech discussion, because of the audience, okay? When I submitted the paper to the conference, I didn't realize, this is maybe 80% or 90% practitioner, okay, plus just a few academic papers. So the academic presentation is usually done in a very different way, okay? We tend to give the big insight in one slide and spend the remaining 90% of time trying to kill the same horse using 100 different ways, okay? This is a weird analogy to mention in Kazakhstan, given how many horses you have here, right? That's too much work. So I decided to change the presentation, just make it simple. So let's see how it goes. When we think about FinTech in general, well, it's supposed to be very advanced, tech-driven, and people enjoy the consumer surplus from technology improvement dramatically. And we tend to think, the incumbents, the financial service providers or financial institutions, they are rigid, they don't really do things efficiently, and that's why we need the technologies. But in reality, let me ask you guys, how many of you have ever borrowed money from a FinTech lender? Hands up, please. 0, 1, 2, 3, good, okay. Okay, there's some at least. How many of you invest through a robo-advisor? Robo-advisor. Okay, again, a few, okay? So I'm positively surprised to see a few hands here. But generally speaking, these FinTech applications are far less successful compared to payment, okay? Payment has really conquered everything from FinTech. But if you look at other more traditional or more hardcore finance business models like lending and wealth management, by and large, FinTech still plays a small role there, okay? You have to ask yourself why. So in reality, what we find is, indeed, FinTech, they have apps, they are very efficient in offering the standardized product, but quite often, you sacrifice personalization. And that can be a very big reason why the services in traditional financial services like lending and wealth management is not penetrated by FinTech yet, okay? So in my own view, okay, so far FinTech has largely solved the market access problem, and I call this FinTech 1.0. And in terms of the service qualities, just now, the quick survey has already spoken for itself. We are not really enjoying a higher or better service in terms of quality, okay? And that's why the market adoption is rather limited. It's only those who have no choices, okay, we go to FinTech. Well, the analogy is like, the black market will have to do it through crypto, okay? And if you have access to the traditional banking services, maybe you just go with the traditional ones. All right, so the FinTech 1.0 problem, why did it happen, okay? It's about a scale versus, it's a scale versus quality problem, okay? When we look at the 1.0 version of FinTech, it solved a major market access problem by faster onboarding, lower transaction costs, maybe less stringent KYC, and market manipulation analytics, okay? At the same time, it's coupled with automated underwriting, and it broadened access to credit and investment universe, okay? So it is an inclusion effort. But if we look at the operating model that can improve service quality, what needs to go into there? Well, we find that a lot of the small ticket loans, typically they're standardized and it leaves very little room for manual customization, okay? Same thing is true for robo-advisors. Customers are typically advised into some sample ETF portfolios. The robo-advisor just solves a matching problem rather than personally customizing a portfolio for you. And that's why growth metrics typically reward speed and the volume rather than quality, okay? So maybe the punchline, the bottom is blocked by the chairs, but I want to say FinTech is inclusive, but does not always improve service quality, okay? So in this paper, we ask a simple research question. We want to say, if we just change the contract design offered by FinTech service providers a little bit, a very simple thing, how much does that matter? And we are using a FinTech lender as a laboratory for this purpose. So I work with a FinTech unicorn in Singapore. It has business operation in most ASEAN countries, and we did this experiment in Indonesia, okay? So we specifically look at a simple element that is done by traditional banks, which is payday alignment, okay? When you go to a bank, you want to borrow, the banker is going to ask many questions, right? Things like, how much do you make? When are you getting paid, right? What's your liability cycle? And banks will try to match your liability with your liquidity, okay? So it's a very simple design, often adopted by banks. Even payday loan lenders, they know how to do it. But if you ever try to borrow money on FinTech apps, if you ever try, sign up on those FinTech apps, you're going to realize they only offer standardized products like 28 days, 1 month, or 2 months. It doesn't really matter when you borrow. They always give you the same tenor, okay? So what we try here is, by changing the contract design just a little bit, can we improve loan performance? So the setting, as I told you, is in Indonesia. Our FinTech lender, okay, the collaborator, offers 28-day loan there. It's uncollateralized cash loans. So you can imagine delinquency rate is high, okay? And it's wholly mobile-based, and the borrower can report their own salary payday, but the lender was not using that information at all, okay, until we decided to do an experiment. Now, the key contract feature here is we want to pick a few loans and shock it by extending the maturity date just slightly by 1 or 2 days, so that now the new due date crosses the pay date. So previously, a borrower has a loan maturing, let's say 1 day before the person receives salary. And now, after the treatment, the person receives, after the person receives the salary, now the loan matures. So this is the main treatment we exert, okay? So let me show you the first piece of evidence. We do this in a randomized experiment. with about 3,000 loans. Okay, and here the treatment is, like I said, we push the due date cross the borrower's payday after the extension. And what is the result? The loan overdue rate decreases by almost 30% in our experiment. Okay, if you simply shock the loan maturity date by 1 or 2 days, and trust me, we did this very carefully by creating a lot of placebo groups, so the effect doesn't come from just extending the maturity. The effect comes from the fact that this simple extension of maturity helps the borrower cross a payday cycle. So now the borrower has enough liquidity to pay. And then, of course, very intuitively, right, the default and the delinquency rate goes down. Okay? So this is a very simple experiment with very strong impact. Okay? And we did this in a controlled experiment, but of course, we can also look at a bigger picture. So we got the lender's loan book, and we look at the full administration loan book of more than 1 million loans. Okay, we find the same pattern in the data. Of course, it's not a controlled experiment. And we look at more than 300,000 borrowers. Okay, and we find in that admin data, the overdue rate still falls by more than 15% if the loan matures shortly after the borrower's payday. Okay? And the impact is quite profound. It's not just the short-term overdue rate decreases. Okay? The penalties for missing the payment and the penalty interest also fall. And the longer-term default rate also reduces. What is the consequence? If you think about financial inclusion, this is all working in favor of the borrower because now borrowers have better future credit access, right? If you just narrowly miss a payment, it can seriously affect your future borrowing capacity in an adverse way, okay? So if you can avoid missing the payment in a short window, these borrowers can repeat, okay, as a customer. So this is a very small contract design change, and we find the impact is large, okay? And then who benefits the most from that? Well, we find it's indeed the underserved borrowers who benefit the most. So who are these people? We find the benefit is larger for young borrowers, for low-income borrowers, for high leverage, which is high loan-to-income borrowers, and finally for low credit score borrowers. So this is exactly we want financial inclusion to play an important role, okay? So you might be wondering, well, if it's all that great, why didn't the lender implement that, right? So we talked to the lender. So they agree this is great. And they kind of confirmed their own intuition and observation. But when we suggest the implementation, immediately we were caught by a lot of the legacy issues. For example, a system has already been built like that. To change that, not only you have to change the technologies, but also you have to convince all the funding partners, including banks, funds, and those funding partners did not agree to change the terms easily because those terms were previously written after risk officers, compliance, putting so much work on that. And now you want to change the game, you hit the wall, okay? So for these simple things in academic sense, it indeed requires a lot of collaboration in the whole ecosystem, okay, to implement. Technology is not the bottleneck. Rather, it's the coordination among multiple players in the industry. So if we face the same bottleneck, what did FinTech players lose, right? So we look at traditional loan officers, they do a lot of KYC in a slow way, and just now, there was some dissatisfaction regarding how things were done in the traditional way. But when you look at the tech way, okay, quite often the tech approach standardizes things and oversimplifies things too much. Okay, and you may need a lot of nuances or domain expertise going into the product design here. All right, So now let me quickly talk about the FinTech 2.0 scene, okay? So I have been following all the FinTech development, including robo-advisors, for more than 10 years. And like I said, traditionally, we find FinTech automates things, it reduces the cost, and it really included a lot of people into the service, financial services. However, a lot of the high-end or premium, high-value-added services are still largely provided by human officers like loan officers, relationship managers, private bankers, okay? And that is because the automation technology was not available 10 years ago. So I waited until the ChatGPT moment. Then I told myself, this is the time, okay, to go into robo and the more personalized FinTech. So indeed, AI can be a game changer to reduce marginal cost of customization. Because indeed now the human part, it's the customization part that makes the tech or FinTech product different now. And to achieve that, you will need the help of AI together with human experts' domain knowledge. So FinTech 2.0 is no longer about reducing market entry or lower fees. It's no longer about opening an account with $1,000 or $100, okay? But it's about millions of personalized financial products for millions of users, okay? So we can see applications in lending and in wealth management, right? In lending, this is straightforward. You can customize repayment date, you can synchronize the payment schedule, or negotiate on grace period when a loan misses the installment, right? But more excitingly, on wealth management side, I want to bring AI as a private banker to the mass market. So if you think about what private bankers do, they collect a lot of soft information and personalize portfolio solutions to multiple users, right? And these bankers are extremely expensive to use. But now AI can potentially fill the gap, provided tokens are not more expensive than billable human hours, okay? And in order to do that, I want to point out a low-hanging fruit here. The low-hanging fruit is indeed to learn from the incumbents, the banks, okay? They know what they are doing. It's just, traditionally, it's too costly to automate or to personalize the key part that bankers add value to. Or you can also learn from academics where insights have been extracted from numerous studies, and then use AI to scale what used to be expertise. And I believe this will be the new chapter of FinTech to start offering customized solutions to millions of users. So this is my conclusion. FinTech 1.0 democratized the market access and reduced the fees. Now we are at the beginning of FinTech 2.0, which will further democratize the expertise with the help of AI. Thank you very much for your attention. Sure.
Do you have any question in the audience? I actually have one. Your first part about the lending mechanisms made me think of early days in crypto where we were learned to highlight that crypto is democratizing access of people who are unbanked, who do not have all these collaterals that could be actually used for traditional loan institutions. So how does this group and community of people in the countries that maybe are not present here, because usually we are those fortunate who can travel and come. So how this community can enter your insights in the structure that you have presented. Thank you.
Thank you. I don't think this is a specifically crypto question. Okay, so for blockchain applications, I have been studying blockchain for also more than 10 years. It's a good technological infrastructure to build applications on. But so far, in order to include the people, I think there's a long way to go, because the old decentralized or semi-decentralized vision, like Libra or Facebook, it's not compatible with the current political order of central banks and the monetary, sovereignty. Okay, maybe Facebook was unlucky. In 2017, there was no National Bank of Kazakhstan eager to collaborate with Facebook, and that's why the Libra project was banned by all governments and central banks. And now they changed the name to Diem. Still, nobody wants them. But I don't know. You see this potential conflict. Central banks essentially they want to do their own CBDC, right? And working with the private applications faces the potential risk of becoming obsolete one day. So as long as you have this tension between the current political system and the decentralized vision, I don't think there's an easy solution. Okay, if you ask me personally, I think the solution will be metaverse. Okay, one day, if we spend, a significant amount of our time in a metaverse, then you don't really need to worry about the constraint from the incumbents, and their financial inclusion can be rolled out much more easily. But in this world, I doubt, there's a lot that can be done very quickly. That's my thought. Yeah.
Metaverse also comes with a cost. Can you take a mic, please, so that I will bring this one to the... This will be last, okay, before coffee break. We all need.
Thank you very much for your presentation. In Kazakhstan, one of the largest banks is actually a FinTech bank, so we are very well exposed to FinTech lending. I have three quick questions. First, if there is a great advantage of increasing maturity by 2 days, like dropping delinquency by 15%, your answer is that legacy issues is not very convincing to me. I believe if you increase maturity by 6 months or 1 year, the delinquency will drop to 0. I believe so. So I don't see any disadvantages for a FinTech company to increase maturity, first. Second quick question, how did you treat February with 28 days, etc.? And third, if you did one of the approaches with the experiment, did you follow the same people when increasing maturity? Oh, okay, thank you so much.
Well, this is more like academic questions, or the questions I typically get at an academic conference. Okay, so first of all, maybe I went too fast just now. So when we treat them, we also have the control groups, right? So they also got a 1 or 2 day extension. But the difference is, for the control group, their extension doesn't help them pass the payment cycle. So we want to tease out just the liquidity effect. And to pitch this to my FinTech collaborator, it was really easy. They also wanted to do that. But the bottleneck is not the technology, it's not the pitching to the FinTech leader. I mean, the CEO is a very good friend of mine. But the real problem is the FinTech lender works with banks. They actually help banks underwrite these loans. Essentially, these loans will end up on many banks' books, right? And then for that arrangement, the banks are not okay if they extend the loans by 1 or 2 days. So that's a bottleneck. Yeah. So I'm telling them, okay, wait after we publish the paper in a top finance academic journal, and now you can use this to lobby the funding partners.